Your mortgage payment is $1,800 per month. You think you're building equity? Actually, you just paid the bank $1,400 in interest and $400 toward your house. Welcome to Boldbox, where we decode the mechanisms the 1% deploy while the 99% stay distracted. Here's what banks don't explain when you sign that 30-year mortgage. In the first 10 years, roughly 70% of every payment goes straight to interest. Not your house, not your equity. Pure bank profit. By the time you actually own the home, you've paid 2 to 3 times the original purchase price. Let me show you the mathematics they keep invisible. $300,000 home, 20% down. Mortgage for $240,000 at 7% interest over 30 years. Your monthly payment, $1,597. Sounds manageable. Here's what they don't highlight on the paperwork. Total amount you'll pay over 30 years. $574,000 for a house that cost $300,000. You didn't buy a house. You bought a wealth transfer mechanism disguised as homeownership. But here's where the trap gets sophisticated. The amortization structure. It's engineered so early, payments are almost entirely interest. Year 1. $16,000 paid. Only $3,000 reduced your principal. $13,000 went to the bank. Year 5. Still 65% interest. Year 10. Still 55% interest. You've been paying for a decade and barely own a quarter of the house. This isn't accidental. This is financial architecture, designed to extract maximum wealth while giving you the illusion of ownership. Second mechanism, the property tax and insurance trap. You think you own the house once the mortgage is paid? Actually, you're renting from the government forever. Property taxes never stop. In high-tax states, $4,000 to $6,000 per year minimum. Miss a payment, they foreclose. Even on a fully paid house, you never truly own it. You're a permanent tenant paying the government for the privilege of occupation. Insurance? Another $3,000 to $5,000 annually, required by the mortgage company. Even after the mortgage is paid, because without it, the bank's collateral is at risk. Even when you're the supposed owner, the insurance still protects their interest first. Third mechanism, the maintenance wealth drain. Average annual home maintenance, 2 to 3% of home value. On a $300,000 home, that's $6,000 to $9,000 per year. Roof, every 20 years. $15,000 to $30,000. HVAC replacement. $8,000 to $12,000. Plumbing issues. $3,000 to $8,000. Over 30 years of ownership, maintenance costs can equal or exceed the original purchase price. You're not building wealth. You're signing up for a 30-year subscription to housing costs that never end. Here's what separates the 1% from everyone else. They don't buy homes with 30-year mortgages. They use 15-year mortgages or pay cash. Why? Because they understand the interest trap. A 15-year mortgage, at the same rate, total interest paid drops by 60%. The monthly payment is higher, but you're not funding the bank's yacht for 3 decades. Better yet, they use mortgages strategically, borrow against appreciating assets at low rates, invest the difference in higher return opportunities. Real estate investors don't buy one house with one mortgage. They leverage equity to control multiple properties, each generating cash flow, each appreciating. The mortgage becomes a tool, not a trap. But here's the mechanism most people never see. The rent versus own calculation is rigged. They tell you renting is throwing money away. Buying builds equity, except they never show you the full math. Renting for $1,500 per month, that's $18,000 per year. Buying the same house, mortgage interest, property tax, insurance, and maintenance. $28,000 per year for the first decade. You're repaying $10,000 more annually for the privilege of ownership, that is, mostly bank ownership. And if you invest that $10,000 difference annually in index funds at 8% average return, after 30 years, that's $1.2 million in liquid assets, while the homeowner has a paid-off house worth maybe $500,000 and zero liquidity unless they sell or take another loan. Real example, 2 friends, both make $70,000 per year. Friend 1 buys a house, 30-year mortgage. Friend 2 rents and invests the difference. After 30 years, friend 1 has a paid-off house and $18,000 in savings. Friend 2 has $900,000 in investments and the freedom to move anywhere without transaction costs. Who actually build wealth? This is the mortgage trap. It feels like progress because you own something, but ownership that costs you 2 to 3 times the asset value, while locking you into one location, one market, one property. That's not freedom. That's expensive immobility. Here's the sovereign move. If you buy property, do it strategically. 15-year mortgages maximum, or use leverage to acquire cash-flowing assets, not personal residencies. The goal isn't homeownership. The goal is asset ownership that generates income without trapping your capital for 3 decades. Because here's the truth about mortgages. They're not homeownership plans. They're 30-year wealth extraction plans where banks win, governments win, and you get the illusion of security while funding everyone else's empire. If this intelligence changed how you see real estate, hit that subscribe button. Bold Bucks releases 1 video every week, exposing mechanisms most people will never discover. We're not here to tell you what to buy. We're here to show you who profits when you do.